want to go ahead and get started and go over our webinar this morning. We're going to talk about fair market valuations, and we're going to take probably about 15-20 minutes to talk about it. There's not it's pretty straightforward, and we'll go over everything that we need to, and if there are any questions, obviously we'll answer those. But it's pretty straightforward. It's going to be a pretty straightforward webinar. And then we're going to, at the end, talk about our privacy policy. Some of the things that we will talk about today is we're going to go over examples of qualified independent third parties, how to properly complete the form. We're going to go over the form. I'll put that up on the screen, and we'll go line by line. What is done with the information, what about worthless assets, and then, like I said, the privacy policy. Again, if you got any questions, you can type it in your chat box, and I'll see that, and I can answer that, or you can raise your hand, and I can unmute you. So that's me. I'll be doing the presentation today. This presentation is an informational presentation only. We do not provide tax, legal, or investment advice. And so if you're looking for something like that, you need to consult with your legal, tax, or accounting professionals when making any investment decisions and concerning your account. Now, the question I get just about every time this year is, why do we have to do this every year? And the reason is it's an IRS rule. It's not something that we enjoy doing, sending out, and I know it's not something most people enjoy and get back to us, but it is an IRS rule. And it's an IRS Regulation 4975, and states that assets must be valued at the end of each year by a qualified independent third party. Now, why is that? Well, one reason is that for people that have reached 70 and a half and are at the point where they have to take required minimum distributions, there has to be a value associated with each of the assets to know what that required minimum distribution is. So that's part of it. And then the other part is that the IRS, since IRAs have been around, have been collecting this information to see actually what is out there in terms of retirement accounts. You know, what is the value that, as a collective, what is the value out there, and what is society looking to do in terms of saving, and are they going to be able to retire, and what does that look like? And obviously that would be important for a societal reason. So they collect this, and they go out there and kind of aggregate it and see, you know, what people are doing, what's going on. So the values are sent to the IRS, and this is accomplished by a form we send. It's 5498, and it is sent to the IRS by May of the following year. So the assets are valued as of 12/31, and then by the end of May, we have to report those values to the IRS on 5498, and then a copy of that form is also sent to you in May. It's required to be sent to you by the end of May. So you can see what we report, and it's and what's in the accounts. So the people that actually see it are obviously us and the IRS, and pretty much that's all that that this information is given to. And like I said, and for the reasons that that we do it. How come we're not moving? There we go. So the question comes up: who should I get to verify what my account is worth? Well, first let me say that it's got to be on a per asset basis. It's not on an account basis. The reason is because there are values on each of the accounts, and that's reported to the IRS. Well, actually, it's a total amount, but we keep those separate because that is what our auditors look for. So, and obviously, the total of the assets add up to the total of the account. So it is on an asset basis. If you've got 3 assets in there, we need 3 fair market valuation forms. If there's only 1 asset, we only need 1. And then, of course, on each of the assets, there may be different people or different types of people or different qualified people that can answer those questions. So here they are. And this may not be a complete list, but it probably takes about 95% of the people that can do this. what we've got is, for real estate, we look at real estate and licensed professionals, and what we can use are broker price opinion letters or comparables, or they also may know as comparative market analysis. So those can be used as valuations, fair market valuations for each of your assets, your real estate assets. Now we can also use county property appraisers. So when you get your tax bill on there, there is a valuation of what the county has valued that property at. That can be used as a fair market value and can be, filled in on the form and then given a copy to us with the form. You can always do a certified property appraiser. Now those are expensive. They usually run about $300 to do one, and those are needed for when distributions are taken, when any type of distribution is taken, whether you're taking it for yourself, whether it's for a requirement of distribution, or whether it is a traditional to a Roth conversion. So those are that is when we definitely need a certified property appraiser to do those, to value these assets. In terms of businesses, and we have a number of those, we have independent valuation firms. There are people that do that value businesses and can come up with a number. Obviously, you have to pay for that too. Certified public accountants or CPAs, they can give valuations on different things, including businesses that they may audit, or even real estate if they want to do something like that. An auditor of a company. Companies bring in auditors. They don't have to be certified auditors, and they don't have to sign off. They have to sign off on your form, but they would be in a position to know what the value of the company would be, since they are auditing the books on a regular basis. Obviously, the last trade price of an asset. We've got assets that are not publicly traded, but that are traded in the private sector, such as an example that comes up is bank stocks. So the last trade on a privately held bank stock can be acquired from the company, and what it was sold for the last time any sale was done. So that can be used as a very good indicator for stocks, privately held stocks, of what the valuation is. Also, last trade price would be considered on precious metals. There wouldn't necessarily be a fair market valuation form needed for precious metals because there is a market for that, and we can go out and get that value. So there's not a need for the return of that form for that. An attorney, again, with companies, that could know what the company is about, how it's doing, anything like that. Managing partners of the company. They would be also a qualified an independent third party that could value companies and the like, as could be the CFO, the company financial officer. So those are a number of people that you can look to if you've got private equities, LLCs, LPs, that type. Limited liability companies, limited partnership, joint ventures, that type of stuff. These people would be valuable in coming up with the value for that asset. Then we've got those people that have loans in their IRAs, and for the most part, we really don't need a valuation on those. However, we do need a true number. So if there's been payments through the years or through this year, and that principal has been written down, we need to know that. Your loan servicer, if you have a loan servicer, would be in a position to do that. Obviously, you as the owner of the IRA and would have a table, that a payoff table that would be there too. And then finally, any knowledgeable party. I mean, there are people out there that would know, that could know about this asset, that are independent, they are arm's length away, but still could know about your asset. So that would come into play. I'm going to go back up to the last trade price of an asset. We have some livestock in some IRAs. And so the last trade price, for example, of the cows, what was the last price of a cow that was sold would be a trade price that we could get from you and could be part of the form. Now what I'm going to do is I'm going to go over the form real quick. That's not where I wanted to go, but there we go. Here's the Fair Market Valuation Form. And as you can see on here, the first part you fill out is your name. What is your legal name and what is your account number here. And then the second part of it, you see there are check boxes there for the type of asset that you hold. And there's only going to be one checkbox per asset. So even if you have multiple, for example, multiple real estate holdings, multiple private equity holdings, we're going to need one for each of those holdings. So as an example, let's take real estate, and let's say you own 123 Main Street and 456 Main Street. So you need two fair market valuation forms. Checkbox the real estate, and then right under that is the asset description. What asset are we valuing here? Again, with private equities, whatever the names that would be, promissory notes, that's what, so we know when this valuation comes in, when you send this to us, what asset to assign this value to. And then we have the current fair market value. So we need the date of the valuation. We're looking for a 12/31 date, but not necessarily, we've got some that have come in recently on an 11/30 date, which is fine as long as we have a date of that valuation, because what the IRS is looking and our auditors are looking at is that we have done this on an annual basis, so that the valuation is current within the last 12 months is what they would be looking for, and then what that fair market value is for that specific asset. And then we'd ask that whoever is doing it, making this valuation, who is it? Who is this person that's making the valuation? And then we need their signature. That's what that's for. And then you see that it says, please include supporting documentation with this valuation or appraisal. What is supporting documentation? Well, again, we went over that in that first slide. So for real estate, it would be a broker price opinion letter, a county tax bill, which shows what the county has assessed it for. For a private equity, it may be an independent valuation person signed off by. We talked about the CPA, an attorney, a company officer. Could be, a K-1. It could be some financial statements. What are we looking at for mortgages and stuff? Could be an amortization schedule if something's changed. So those are the things that we are looking for as supporting documentation to verify the value of this asset. And then finally, we ask for your signature. So the account owner's signature would be the next thing that we'd be looking for. Once that's done, you can fax it, mail it, scan it back to us. The letter that you received has got all those ways to do that. Most people now are scanning that back to us, and then we'll go back into the account and make those adjustments so that when we send out the end of year statement in January and the information to the IRS, that it is the most recent information that we have. And then we got questions. So that's the form, and that's what we're looking for from most people to get, and so that we can have that. We put it on file, we change the asset values, and then we're good again for another year. Now, we've had some questions about worthless assets. What happens when our assets that are in our account are now not worth anything? And we kind of break it down into different areas. So real estate is rarely ever worthless. It could obviously decrease in value, and which we can get from broker opinion letters and county tax assessors and stuff like that. But it's rarely ever worthless where we would write it off of your out of your account. So now private equities, that's a different animal. There are some private equities that have gone bankrupt. There are some private equities that have been Ponzi schemes. So what do we need to write off private equities? Well, letters from company officers help. We've had some that have said, it's just not a viable business anymore. We are closing the books as of the end of the year. The value is now zero. We don't expect anything to go back to our shareholders. Those types of things can be acquired from the company and the officers when you know something's happening like that. Bankruptcy filings. Obviously, if a company is in bankruptcy, its shareholders usually don't get anything, and so that would be substantiation, backup, supporting documentation to write off that type of asset within your account. Also, notice of receivership in terms of Ponzi schemes, which we have seen a few of, and the state Securities and Exchange Commission gets involved, and they assign a receiver and to look at what the assets are available and dealing with that. So that's also good for writing down or writing off equities. And then finally, on a promissory note or mortgage, we've got a form which is called our worthless asset form. And promissory notes and mortgages can go bad when obviously people stop paying. So the question is, why did they stop paying? Have you seen these people in the last 3 years? Did they declare bankruptcy? What is the issue that happened? I had one that called actually yesterday, and his borrower has now moved to China. So obviously, and he doesn't think that note's going to be paid off. Now, in part of what he's got some collateral in terms of some real estate. So we'll be taking that real estate and we'll be replacing that note with the actual real estate, and then with the value, the fair market value of that real estate when that comes due, once we get it over into the account. So that's the process if you have a worthless asset. And then finally, so that covers pretty much what our fair market valuation form and what we're looking to do and why we're valuing it and why we need it every year. Now, our privacy policy, I want to touch base on real quick. We send that out once a year. It's usually mailed with your annual account statements in January. It states what we do and what we don't do with your information. We do collect a lot of personal and secure personal information, obviously. We have to open your account and comply with the USA Patriot Act. But as most of you know, the information we collect is information to open and administer your account, provide online access, deliver services, statements, collect payments, and inform you of different things that are going on, such as this webinar. What I want to point out is that we do not sell any or in any way release your personal information to any third party. All of your information is kept here, and it is on a need-to-see basis here within the office. What's important here is that we get people, probably a call every other week or so, that we've got people that these people call and say, they've got a great deal and they know we hold self-directed IRAs, and our clients may be interested in investing in some of what they're offering, and you never see that from us. And the reason is that we tell them, he says, one, our client list is extremely confidential. We don't sell it. We don't give that out to anybody. And so that's the first thing. And secondly is that's not part of what we do. We just facilitate transactions. We don't bring to you different types of assets that may be out there or different offerings. That's your part in terms of a self-directed IRA. So again, we get these probably every other month, but we don't let anybody know. We tell the people, we thank them for inquiring, we thank them for calling us. Sometimes you may see us do a webinar with these people in terms of not a selling webinar, but we have some people on that give us an idea or give clients an idea of a different type of investment that could be out there. We did some with some private lending and crowdfunding earlier this year. So that's to put everybody's mind at ease, is that all that information is kept here, it's housed here, it's on our secure servers, backed up probably twice a day, and and also remotely stored. So all that information is safe and away from anybody that doesn't need to see it, and which talks about securing your personal information. So that about covers the webinar today. I'm going to unmute. I don't see any. Well, first let me ask if there are any questions. I don't see anybody's got their hand up, so I don't see any questions. But what I'm going to do is release everybody and see if anybody's got any questions. There we go. Looks like Lisa's out there. She's got her hand up. Lisa, what's your question?
Okay, so
Lisa? Okay.
hi. What happens if you don't?
Let me do this. I'm sorry, Lisa, can you hear me?
Yes, we can.
Okay. You got a question?
What happens if you do not receive a valuation?
If you do not receive that from who? From us, the form, or?
From the form.
So if we don't get one back?
Correct.
We keep contacting you to try and get one. That is, that's what our auditors look for. That's what the IRS requires us to do. So if we don't get a form back, we can't, obviously we can't make anybody give us a fair market valuation form, but if there is a history of not reporting, then our custodian looks at it and says, why aren't we getting anything here? Have you talked to him? Have you, sent him some more, talked to him, done some stuff with it? And after maybe a year or two, we may have to resign because it is a requirement that we have to do to get these fair market value forms and amounts into our system so that we can report accurately to the IRS.
Thank you.
You're welcome. Anybody else? All right, I don't see anybody else's hand, and I don't see any messages there, so we're done. Again, should you have any questions on this, you can always call us here at the office. We're here to help you, and if you got any questions about filling it out or assets that we may not have covered here that are kind of different than what we've got there, and questions about how to value those, we'll be glad to help. I hope everybody has a great day. Thanks. Bye.